The recent 12-year bull market has had very, very few interruptions. The biggest one was the pandemic. As a person who's considered to be a perma bear, which is somebody who always thinks negative about the market, I was told, oh, all these facts, I don't see anything on the horizon that's going to cause a problem. What I've always said is, I believe in the John Hussman idea of looking at things. Overvalued markets are like a room filled with gasoline and a fireplace in the middle. We don't know which spark will cause the explosion, but what we do know is there will be a spark that causes the explosion. When you're in a marriage, and the very last argument is because the milk was left out and they got divorced, is the milk being left out the real reason for the divorce? No, it was a buildup. And in my opinion, overvaluation is that fire is the gasoline in the room, and overvaluation is the buildup to that one final fight. It just takes that one final spark to cause it. In the last 100 years, where has the market gone? It has gone straight up. But along the way, there have been many, many times the market's fallen over 40%. And guess what? Every single time, nobody saw it. And their comment is, well, and then in hindsight, they'll say, well, obviously that happened. Well, unfortunately, leading up to it, everybody invests in stocks like there's not going to be nothing negative in the future. I promote a margin of safety. So I'm Paul. I'm a value investor. If you're new to this channel, understand that my goal is to make conservative assumptions about a company and buy with a margin of safety. What's a margin of safety? I want to buy a company for less than I think the market deems it to be worth. If the market price is 100, I want to buy it for 70 or less, or some sort of ratio, depends on the company. My goal isn't to make egregious assumptions about the future. My goal is to make a conservative assumption about the future and buy at a price lower than what those assumptions give me at. Now, that tends to mean I need to find companies that are out of favor. I'm okay with that, because I do believe that in the short run, stocks are a voting machine. In the long run, they're a weighing machine. So in the long run, the fundamentals and the balance sheet are going to drive the value of the company. In the short run, it's going to be the retail public's opinion of that company that drives the stock price. That is not the way I want to invest, because it makes the hype go up. And go watch our videos over the last 2 years. Every hype stock out there that I criticize, I believe is down. Maybe not Tesla, but I think Tesla will be one of the final ones to go down. But when it does, it will go down very hard. They've got the Tesla fanboys out there. I get it. But I remember back in February of this year, stocks started to fall. And all these other YouTubers said, well, I never saw the Ukraine war. Well, neither did I. But what I did see was there would be something. In 2020, I didn't see the pandemic. And all my friends said, Paul, you don't get it. The pandemic caused this. Okay. Yes, that was the final spark that caused the explosion. But that wasn't the real fundamental. Overvaluation is the real reason why it works, why it fell. Go look at every burst in history. We look at, usually, there's some event that causes it. Now, in the 2000 tech bubble, it was just capitulation. Right? People might say 9/11. Well, if you go look at the chart of the S&P and the NASDAQ, after 9/11, stocks did fall further, but they'd already fallen a ton still. And they had more to go. I sit there and believe that the event that causes the big disruption, we don't know what it'll be. I've over almost 1,700 videos out there. And in many of them, I talk about, I don't know what the reason will be, but there'll eventually be a reason where people go, oh my, I look at inflation now and people are saying, well, inflation's like, well, guys, we printed a ton of money. And that might be your excuse, but the point is we've had recessions. We've had overvaluation, and it never works out in the long run. There's just some sort of reason something happens to cause stocks to fall. Your job to be a good investor is to realize those events are going to happen and to be a little cautious when you buy your investments. Buy companies at good prices. Does that mean your stocks won't go down? Absolutely not. We have a nice big community here. And this weekend, somebody was saying to me, Paul, how can somebody be a value investor and have stocks go down? Well, guys, if stocks went down 60% in the next year, you're going to be very, very hard pressed to find any stock that doesn't go down. But your goal should be to find stocks that go down less than everybody else's. And in the long run, if you can beat by 2 or 3% a year, like Ben Graham wanted, you will crush the market. Over 30, 40-year period of time, beating by 2 or 3% a year is many, many times your extra money than just following the market. Or if you don't want to pick individual stocks and you're okay matching the market, buy low-cost ETFs and dollar-cost average. Study after study shows that when people try to get in and out of the market, they tend to do very poorly. Let me show this very famous chart that I always talk about. This is the stock market's value over time, but this is the pricing of the market. Your job should be the dollar cost average. And sometimes you're going to overpay and sometimes you're going to underpay. But over long periods of time, you're going to average this, and that should be your goal. But what usually happens is people buy here and they sell here. They buy at the wrong time and they sell at the wrong time. Why? Emotion. Emotions are hard, they run high, and when you have a bad emotional state with money, you make irrational decisions. Take the thinking out of it. Just dollar cost average. Stay in there. Put your money to work and realize that what you care about is decades down the road. Even if it's 10 years down the road, your job, even if I told you right now, which I truly believe, that stocks will probably be about the same level they are today, 10 or 12 years down the road. You might sit there and say, well, I'm going to make no money. Not true. Because in order for stocks to be the same, they probably have to go like this. So if you dollar cost average, along the way, you're going to end up paying an average of this. And 10 years down the road, you're going to have made more money. And that's the point. We never know where stocks will go in the short run. Back in 2017, I thought the S&P was worth about $1,500, $1,400 on the S&P. Now, I think it's much higher because fundamentals have gotten better. Now, is it much higher to the tune of 4,000? Absolutely not. I still think stocks will go down in half. There are three main metrics I look at. The first one is the price to sales ratio. It takes the entire stock market cap and divides by all the revenue. It's currently at around 2.5. Historical average is 1. It shows it needs to drop by over half. Metric number 2 is the 10-year cyclically adjusted PE ratio. It takes the last 10 years of earnings, brings it to today using inflation, and divides the entire stock market cap by that. Historically, it should be 15 to 16. Today, it's over 30. Shows it has to fall in half again. And the final metric is the Buffett indicator. This is the one that Warren Buffett says is probably the most reliable metric of stock market valuations at any given time. It's the stock market to GDP ratio. Take the entire stock market cap, divide by total US GDP. You should be wanting to be around 80%. You'll do quite well if it's around 80%. It's currently at around 165%. So again, needs to fall in half. 3 long-term reliable metrics saying that stocks have to fall in half. I truly believe these have to happen. And I look at the way we are, where we are with inflation, interest rates going up, things like that, and I think this will eventually happen. The last month and a half hasn't felt that way because stocks are up 10, 12, 13% since the end of June. But eventually there'll be an explosion in the room of gasoline. We just don't know which one it'll be. Could it be more inflation? Could it be higher interest rate? I don't know. But the point is, eventually people will care about valuation and they'll care with a vengeance. You've seen stocks like Peloton go from $180 to $12 very quickly. You've seen all these hype stocks collapse 80, 90%. The stocks that I was told I was stupid for telling you to avoid back a year and a half ago. Go watch those videos and go see how I looked at my process. If I don't understand it, I avoid it. If this makes sense to you and you like our process, please watch our next video where you can understand our 8-pillar process and how we look at stocks. And please remember to subscribe and share this video. Thank you very much.